Good day. Welcome to this episode of Savannah Investment Group. Today we are going to talk about something that you have probably heard. It's an investment strategy that is widely taken out there in the market. It's to do with the buy and hold strategy of investment. I am no longer a proponent of this system of investment or probably the strategy. And I'll go on to explain why. In the next episode, we would look at what I would propose in place of the buy and hold strategy. So yes, to begin with, what is buy and hold strategy? This is a strategy whereby you buy shares or an asset and accumulate over a period of time. Most people that I see are buying ETFs on a monthly basis. And the rationale behind it is that you buy regardless of what the market is doing, and you continue buying. The actual expectation is that you are going to hold that asset probably for a minimum of 10 years. Then after 10 years, maybe you might review your strategy or review what you did and see how much you made, and then probably redefine your goals as time goes. Now, like I said, this is something that I tried when I began my investment journey. So I bought shares for ShopRite and Mr. Price. And when I bought those shares, ShopRite was around 220 Rand per share. Mr. Price was sitting somewhere close there, more than 100 and probably more than 200 Rand per share. After I bought, I realized these shares went drastically down. ShopRite went close to 100 Rand after the recent drop down in the prices. Mr. Price as well, it lost a substantial amount. When I looked at my account, the drawdown was coming to close to 50% of the value. So I looked at myself and said, this has been about 6 months to a year of investing, and I've already lost 50%. What is the chance that I'm going to recover this amount of money? I started questioning myself. I questioned the strategy, and I was at the time comparing the strategy with my goals, whether there was a fit in terms of what I wanted to do after some time. So that is when I said, no, I need to find another strategy. I need to re-strategize and define a new paradigm with which I was going to invest. So while I look in the market or out there, the buy and hold scenario is heavily sold. Now, why is it heavily sold and believed in? One of the things I've realized is that the people who sell it most are people who have probably worked at insurance or investment houses. This is the strategy that they use. When they receive monies to invest, they go into the market and they buy and they hold. They know that over time, the asset prices are going to go up. So these are the people we have taught most of the people. These are the people also who have taught me and led me on the path, like I said, that I began with ShopRite and Mr. Price. But clearly it was failing. Because when I considered whether I'm going to recover what I had put in and the time frame that I needed, it was looking bleak. So at some point I had to say, I'm pulling the trigger, I am getting out. Because one thing that you need to consider, especially given that we have had a large drop in share prices, you need to ask yourself, who is selling? We have seen sell-offs in markets in USA, in UK, in Japan, in China, even in South Africa. We have seen shares drop significantly in the month of March. And so if the people who are in investment houses are saying, hold on throughout the crisis, things will get better, prices will pick up, then who is doing the selling of all the shares that we see? Because when you consider it, the sell-off at the lowest point, trillions had been lost in the market. let's face it, retail investors alone cannot pull such an amount out of the markets. It is impossible. Because if you are looking at millions and billions of shares that are being traded, it is beyond the power of the retail investor. So somewhere, somehow, there are institutions that are selling where they're saying you must hold on. Then we also need to consider why things go bad in a crisis. Because when you look at most of the charts that are cited that look, if you had held the S&P from 1998, set through the crisis in 2000 and 2008, look, you would have made so much money. And it's evident when you look at a historical chart that there was no need to panic. You all just need to sit on your hands and do nothing, and you would ride out the crisis on the other side. But then the question remains, who sold and why did they sell? It was investment houses, it was retail traders, it was everyone who was selling. So why were they selling? The nature of a crisis is that when things are going well and the market is doing well, you do not need your money back. But when it starts raining, you are going to need money. The reason why recessions are so hard to sit on hands is that, one, you are living it in real time. The pain of seeing large drawdowns in your capital is not something that many people can stomach and sit through. Secondly, recessions don't just come to the markets. They'll end up in the streets. They'll end up in your workplace. The challenge is that if you lost your job and you had your house rent to pay and you needed food for your house and you needed to pay for your car, what are you going to do? There's no more salary that is coming through and you need something to work with. What do you resort to? Well, first you're going to start maybe drawing on your emergency fund. When your emergency fund is exhausted, what do? You move on. What else can you sell? If you have got shares, then you need to sell them. This is the nature of a crisis. It doesn't just hit the stock market. It hits right down to the pocket. Currently, we're going through a COVID crisis, which is also exacerbating a financial crisis that was already unfolding. So think about it. If you lost your job tomorrow, what is the expectation that you are going to get another job in the next month or 2 or 3? If the probability is low, then you are going to need something to use throughout the time that you are not working to meet your expenses. The challenge that most people like me have is that you are most likely a millennial. You learned investing probably maybe in the past 4 or 5 years. And you're somebody who doesn't come from a background that is well up so that you have got a large capital built. You did not inherit a house. You did not inherit any money from your parents. You are starting out on this journey and you want to be the pioneer in your family. So there comes the mounting problems in crisis. You lose your job, you need to get back the money that you had put in. And you are taking that money out at its lowest. Most places where people invest, they will penalize you for taking the money out because they are also going to sell into a low price market. So now you are stuck. You are going to get less money than what you have put in. It's now back to square one. The other thing that you need to consider that is underestimated of recessions is the time that it's going to take for you to recover. If you lost 50% value of your portfolio, say in 2008, how long did you need for you to break even? If you look at the charts, most times you needed probably at least 5 to 7 years. So you can consider that you are sitting in a loss position for 5 years. After 5 years, you start a bit of recovery. So you have lost 5 years where you have put in money, but you didn't make a profit. How does that affect your goals? If you are looking at 10-year time frame, suddenly you have been reduced to 5 years to recover everything. What if the markets don't recover in the next 5 years? Or in the next 5 years, what if when they start to recover, something happens? Because remember, if you look at the 2000 crisis and the 2008 crisis, it's only a difference of 8 years. Now, if you take the time from the bottom up to recovery or a break even before 2008, you would find that there's a small marginal percentage where you set in profit before you took another hit towards the bottom. Now, because markets, when we look at a chart, they are stretched going backwards. You can look at an S&P 500 from 1990 up to current date, it looks like it's just going up. But your goals are not measured on the same time frame as the chart. Your goals, if they're 10 years, you need to look at a 10-year period whereby you're doing very well and you have made profit, and you can continue to do that. And also your life is limited. The years that you are most productive are probably maybe from 30 up to the age of maybe 55. So you have got that small window to make as much money as possible so that you can have comfort when you reach the 55s. Now, business cycles have become shorter and they have become fierce in the way they run through. Do you want to sit out and lose 5-6 years of your time waiting and then expect to recover? I would say that is naive. Ever since I went into ShopRite and Mr. Price, the shares have not recovered to the levels that I bought them at. Probably the drawdowns are sitting at about 35 to 45%, which is huge considering that we are now sitting in a recession which is threatening to be a depression. So the time factor and your goals are very limited. You only have maybe 2 decades to get everything right. If you lose those 2 decades, you're probably going to be under severe pressure as you near the 50s. Then that will make you take more risk. More risk means you are probably going to lose more. At the end of the day, you say this thing is hard, I tried, but I couldn't do it properly. It doesn't help or it doesn't console that everyone went through the same crisis. You had a goal, you are going to confront yourself for achieving or not achieving that goal. So another thing that you need to look at is what can work. What is the thing that you should do? How should you handle the markets? Should you go to the market as somebody who can probably sit for the next 30 years waiting for things to happen? Or do you need to take a different approach to the way you handle your finances? In the next episode, I am going to talk about how I made a change, how I decided this is not working, or it's not working for me, it's not helping my goals, it's taking me backwards. How did I manage to navigate to where I am today? And what has been the lesson? How did I refine the strategy that I am using? Because at the end of the day, we all want to achieve financial freedom at a fairly young age. If you are like me, you are probably starting your journey later in life. So you need to catch up, you need to find yourself in a position whereby if you are to retire, you need to leave a legacy and say, I'm passing this legacy of information to the one who comes after me. So those are the things that we'll look at in the next episode. For now, I hope you are safe wherever you are and try to help yourself as much as possible, because more than the pandemic, you need to have a life after the lockdown. It doesn't help to try everything now only to lose your life or to lose your wealth, because who knows, if you catch this virus, you might end up in hospital. ICU goes for about maybe 20,000 Rand a day. You would want to sell off your investments to cover your medical costs and end up with nothing or back to zero. So take care of yourself. Until the next episode, happy investing.